Hello everyone, welcome back to the channel. Matt with Green Bar Trading here. So I'm going to go over a few things in this daily update. I'm going to go over the 3 trades that I took, very quick trades, scalps. I'm going to go over yesterday's FOMC meeting and what Powell said and how how the response was on the stock market, what it all means, and I'm going to try to do that as simple as possible because a lot of this stuff can get a little too complicated, especially if you're a beginner. But even if you're not a beginner and you just want to learn some more about those macro forces that have been moving the market for the last 2-3 years, it's been really crazy. And this year is no exception. So getting into it, let's just first start here. So $215 on 3 trades. Each trade was less than a minute. 20 seconds on my first scalp, 40 seconds on my second scalp, and just about 30 or 40 seconds on my third scalp. So that's a really, really quick, good entries, good exits for 215, very little market exposure, especially a day after FOMC and a day before the payrolls, the NFPs, which are tomorrow, which is a really big deal for the market. So that's the trading day right there. Got that out of the way. Now what I want to show you guys is how the market responded yesterday. So in order to do that, first we have to go over and look at what happened. So Wednesday, 2 p.m. And by the way, I say this in almost every video. You need to make sure you know the economic calendar. It's very important. Not just our economic calendar. By our, I mean the United States. There's other economic calendars that you can look at that have all the other countries, because sometimes, especially this year, their markets can also move ours. But anyway, getting into the FOMC announcement, they went with 75 basis points. That was expected. That was priced in. No shocker there at all. When this came out at 2 p.m., the announcement, so a couple of data points come out, a couple of quick little messages from the release comes out. And then the news takes that and they start to trade on it, especially the algorithms. One thing that came out at 2 p.m. was something about the fact that they might have a bit of time in between raising rates to see where the overall market goes and how it affects the economy. So that was taken at 2 p.m. to be very dovish. Now, what dovish means is a Fed that is going to be, pulling back a little bit on the reins. Because right now they're all in to fight inflation, almost willing to crush the entire economy. So this came out as a little bit more dovish, meaning, we're going to loosen monetary policy, maybe even pause, which would be a very big pivot to what they were doing. So that came out at 2. The market took that to mean that was a good thing. And I'll show you on the charts how the market goes straight up. And a couple of key things that we look at went straight down. And then Powell started to speak at 2:30. And that's when things really took a turn down, the market. So it says here, Powell plays both hawk and dove. This is what I was talking about. So at 2 o'clock, everything was lovely. The market went up. 2:30, the market starts to gyrate a little bit. And a couple of questions that Powell was asked, he really walked back that dovish sentiment that he saw the market move. And he said that it is very premature to talk about a pause. the pause was the whole reason why the market went up. So he said that they have a lot more work to do. He also said that the terminal rate for the Fed funds is actually going to be higher than initially expected, and they may have to hold it there for longer than expected. And then he was asked a question about, now that that's the case, how is that going to affect how he sees a soft landing happening? He stumbled on the words a little bit, but he basically said that a soft landing, now that they have to raise rates higher to get to their terminal level, which is going to be in the middle of next year, now that they have to raise them higher than expected, he said that a soft landing is now going to be, the path is going to be much narrower than expected. So that's the reason why the market took an absolute nosedive and literally moving on those really quick algorithms. Right when the sentences were coming out of his mouth, the market was dropping a huge amount. So anyway, that's the Fed, that's the FOMC. Now, if we look at the market, this is yesterday's trading day. So a lot of times what happens before a big announcement, you'll see very little volume, right? Look down here, very little volume. It'll chop around a little bit, right? And this was chopping right around that 50-day moving average on the SPY. So that's a very, very key level, extremely key level to look at. So if we just dial this in a little bit bigger, at 2 p.m., you see these candles. This is a 1-minute candle. It went from 382 all the way up in 3 minutes to a high of almost 388, which is, a 6-point move on SPY in 2 minutes, 3 minutes. Well, that's a lot. And then, like I said, it chopped around. And then at 2:30, you can see this movement right here. And this right here at 2:35 just plummeted when he said those things that I just read to you. And then again over here. And then when he was done speaking, which was right around here, the market just sold right on off because there was nothing else left. The market was digesting the information and the market sold off. Now, something that we also look at is the bond yields. This was yesterday's bond yields, the way that the yields were trading on the 10-year. And this is the dollar index right here. So you could see when the news comes out on the dollar right here, the initial response was a sell-off in the dollar because a more dovish Fed, right, maybe a pausing of rates, well, that would make the dollar come on down. And then right here is Powell speaking. No, we're going to actually raise rates higher than expected, and we're going to keep them there longer. Then the dollar rallies. The complete opposite, the complete inverse of what the SPY looked like. Same thing with the bond yields right here. If we just dial this in, the yields dropped because of a dovish Fed, and then the yields rose when the Fed was going to be raising rates and keeping them higher, and also it gapped up huge overnight. All right, so inverse, the TNX, the inverse, the yields. When the yields were pulling on back, the market was going up. When the yields were coming back up, the market was dropping. Same thing for the dollar. And if we want to look at the VIX, we could take a look at the VIX as well. So the VIX yesterday initially dropped. When the VIX goes down, the market goes up, and you can see exactly what happens after that, and then it goes on up. Right here, this is exactly what the trading day looks like. The market at 10 a.m., and I'll pull that up in a second. But at 10 a.m., we got a big dip buy as this market goes up, which is the SPY, the VIX went on down. So just know those three things: the VIX, the dollar index, and the treasury bond yields. They'll move different than the overall market. That's what's been going on just about all year long. So last thing I want to show you guys is tomorrow. Keep in mind, we have NFPs at 8:30. We have the unemployment rate at 8:30. Expected 3.5% unemployment. The Fed wants to see a higher number, a 3.6, a 3.7, a 3.8, whatever that does with the unemployment. If that does happen, it will be good for the stock market, bad for people that are losing their jobs. But the Fed wants demand to come on down. The Fed wants the economy to start to show, and the labor market to start to show weakness. So far, it hasn't. So far, these reports have been much hotter than expected, meaning all those rate increases that we've seen have just barely dented what the Fed wants to do. And that mostly happened in the housing market as the mortgage rates went up and made it very unaffordable for people to actually buy a house. So that's it, guys. I hope that you maybe learned a thing or two. If you did, hit that like button and subscribe. I'll see you back on the next one. Take care.